Ending December 19th. Hope everyone is ready for the holiday season. We still have a couple more weeks left, many trading days left in the year, but for all intents and purposes, the year is over. But, we have to start looking ahead to 2026. And this week, I'm going to really look at cash levels. I talked about this on air this week, but I really want to highlight that once again. And it's the fact that the average cash levels in portfolios is at a multi-year, multi-decade low. What does that mean? Are markets offside? I think is the big question. So I'll continue to uh, really dig into that here in a little bit. I'll take some questions. That's what I really meant. I'll take some questions here in a second. So if anybody has any questions, I know we're going live here on YouTube. So don't hesitate to type in the chat and let me know what you are thinking. I'll be happy to answer your questions as we go along here. So very interesting close to the year. I'll get into the economic data and we'll go from there. So let me share my screen. Going to just go here, share this entire screen. So anything I put up here, you'll be able to see. And this is what I was highlighting on, I think it was on Thursday when I did the show. And it was Bank of America is showing the lowest cash levels. Okay, the lowest cash levels that we have seen since survey began in 1999. So down to 3.3%. These are fund managers. That's from 3.7 in November. 42% of managers are overweight equities, the highest since 2022. So what you can see is this is the cycle in markets. You get over bullishness, and then people are offside, and the market likes to hurt the most people at any given time. And so it's why it's getting harder for the market to really advance here, and you're getting a lot of choppiness because everyone's kind of all in, and the proportion of fund managers overweight technology stocks the highest level in more than a year. Now that's not as worrying because it's only in a year, but obviously there is the expectation that AI will continue to drive profits going forward, and that very well could not be the truth, right? You could see, and you're seeing that with Blue Owl backing off of financing an Oracle data center. I think there's a couple data centers here in California that have been built but don't have the energy to run them. So the industry is running up against these bottlenecks of building capacity, financing that capacity, and all together, they're not even really um, focusing on what is important, which is this business a good business to be in? Building data centers, running AI models, all of this. Is this a good business that trumps the current business, right? Which is for most of these big hyperscalers, they have high margins. Go look at Google's margins, Microsoft's margins, Meta's margins, et cetera. They're very high because they're very capital light businesses for the most part, especially compared to the amount of revenue that they bring in. So that sets up for potential disappointment as we head into 2026. Fund managers is the most bullish since mid 2021. We know it happened in 2022, obviously, that large drawdown. And cash levels, equity allocation, and global growth expectations are setting up for once again a disappointment. So there's just a lot of excitement about AI and the bubble, right? 40. And what's interesting here is that in December, those that say the top risk was the AI bubble actually fell from 45 to 38, which is interesting. So people are still kind of offsides. And global equities, the big question is, can global equities do well if bonds rise? So that's another thing. The survey thought that rates were going to rise. So how can you have rates continue to go up and the market go up at the same time? It doesn't really compute in a material way. So um, that is that story. But let's dig into the economic data, or at least the week that was. So here's the week overall. What you can see is a lot of the Mag 7 struggling. Obviously, Tesla, the strongest, up 7%, Microsoft up 1%, but Google, Apple, Nvidia flat, Broadcom down 10%. And you had some green out of healthcare. some in consumer services, so kind of consumer staples, consumer non-durables, health services and energy materials were down. So, and then retail certainly down. Costco down 3, Amazon down 1, Walmart down 1. So a lot of red, and overall just a mixed bag. So while the market bounced a little end of the week, we did have OPEX week, so I could easily see things changing here in the coming week, and it could go in both directions. Usually, you have an unpinning of the market. Usually, OPEX kind of you get choppiness kind of like this. Option dealers with their ability to kind of move and try to, I don't say manipulate, but manipulate the share price in the short term, and that can happen as well. And then you get a lot of the gamma hedging and dealer unwind happening as you close the week and into the following week. So we'll get a lot more information next week, as well as, from an economic standpoint, there was a lot of data this week, which I'll dig into here in a second. Kind of a mixed bag on what you can really glean from it. So the CPI was the big one. That was only about 2.7% year over year. Problem was the last 2 months, because of the government shutdown or however you want to call it, they only used 3 data points: gasoline prices and used in new cars. So can't really tell a whole lot about inflation, to be honest with you. So I kind of throw that one out. What other data did we get, though? We got industrial production. That was September. So this is also pretty old. But what you can see here is the positive is that there is an upward trend in industrial production domestically. That's certainly a positive. Non-farm payrolls, however, kind of choppy into negative territory in 3 out of the last 6 months. And so we're kind of at stall speed for the overall labor market. You can see that with unemployment rate rising to 4.6%. And obviously the labor supply is shrinking with what's going on with immigration policy. And so if that was if that didn't happen and then we reversed that decision, obviously unemployment rate would be probably north of 5%. Retail sales that dipped down, you can see that rolling over a bit in October. So we'll see if that trend continues into the end of the year, but clearly the consumer in some way, shape, or form is breaking. The Federal Reserve current business activity that did tick up a little bit, so that was a bit of a positive, but still remains deeply in negative territory. Now let's take a look at my favorite. This is what I said on our holiday special, which is which parts of the market or what data points are people not paying attention to, and that is the lending from commercial banks. We're at 5.2%. It's come down a little bit, but still in a positive trend. So overall, you have to say that looks fine. Reserve balances. So we know that the Fed is trying to reliquify the market. They're doing QE. They're buying short-term T-bills and all T-bills are short-term, short-term paper. They're buying T-bills to try to monetize the debt and get these reserves in the system back up. They don't want reserves this low. This is back when we had the Silicon Valley Bank crisis, and that's something that I think will potentially become a problem if they don't do QE, which once again they are doing it. We have a new Fed chair coming in just a few months. Let's see. This is the Treasury General Account. We've talked about this before. Their target by year end is right about 850 billion. Right now they're at 833. So they actually need to bring this back up a little bit, which would be a slight drain in liquidity from the system. Let's look at Bitcoin. Bitcoin, obviously, we know it's the canary in the coal mine, and you're getting a bit of a bounce here. So that is a positive over the past couple days, but this is the past month, very choppy action over the past couple of weeks, still in a downtrend. And really, it's been a downtrend since the beginning of October, right? Now, it's trying to find support here in the mid 80s, but longer it stays here, what we call that is bearish consolidation and will likely break lower. Let's look at the Fed Watch tool, see where we're at for expectations for Fed rate cuts as we close the week. And by April, the expectations is for one more rate cut, maybe two. Now, how does that differ from last week? Maybe a bit more dovish, right? Because it was 39% no cuts between now and then. Now it's only 33%. So it's leaning a bit more dovish on the week. Obviously, that could have been a reason why the markets hung in there a little bit. Is maybe the market pricing in a bit more, uh, a bit of policy. Oh, there we go. A bit of policy that weakness coming in through the beginning of the year. So that was the economic news that we had. Let me dig into the charts here, and I'll show you what we are working with. And I'll start off with start off with the S&P. Gotta love the S&P. That's always most important because that's what most people are invested in, unfortunately. But you have a very choppy period still. Market's kind of not gone very far in the past 2 months. Big volume on Friday. Now that's because of Option X. So you have a lot of, once again, closing of positions, both on the dealer side, individual side as well. So not a shock to see high volume there, but nice little bounce back, close near the highs. That was certainly a positive for markets. Here's SPY, kind of something similar. Let's take a look at the Qs. We know the Qs are heavily tech related. And, this is interesting here. This is what we call an H pattern. And it's probably the most underappreciated pattern, technical pattern I've seen out there. And it's really, the markets pulls back or position pulls back to some support level. It rallies, it makes a lower high, but then it does not make a lower low. Kind of an H, right? And usually that's actually pretty bullish, especially if you can break above the top of that H there. That probably means new highs, etc. So overall, it's shaping up to be a relatively bullish pattern in the shorter term, but obviously it's not guaranteed. These things are just something you want to watch and look out for, and know that market's starting to lean one way or another. And really, it's Nvidia, right? Nvidia was breaking down, and a nice little rally over the past couple of days. Now, once again, it's hard to really glean a lot because it is Option X week, and there is a lot of, once again, market manipulation that goes on in these types of weeks. So we'll see what kind of follow through we get on Friday's action and a lot of these names. And you can go to all the big ones, right? Let's see if this wants to load for me. Don't think it does. Sometimes when I'm on live stream, it gets a little slow for me. But let's go while we're waiting for that. Let's get into some of the other assets. I really wanted to highlight some of the private equity names. Let's see if that was, there you go. So KKR, that one rolled over, making a lower high here. You also have Apollo. Let's go to Apollo. There we go. This is Apollo, and that one's pulling back as well, threatening to make a lower high. This is in a broader downtrend. So I would be a bit worried about that sector as we go into 2026. I think that is pretty up there on my list, probably top 3 risks for 2026. Probably right behind, I would say, the AI trade unwinding, because there's just so much bad lending out there in this space. Very similar to 08 and CDOs. Remember CDOs, collateralized debt obligations? That was a big part of why the housing market crashed, and where there were some systematic risks back then. Now it's in the CLO market, collateralized loan obligations around private equities, these companies that, in good times, they might produce positive cash flow, but these private equity companies, they come in, they get debt financing, from especially these larger banks, and they're buying out the company, and leveraging up the balance sheet, and hopefully they grow out, they pay off the debt over time using that cash flow. That's kind of the model, right? The problem is that these banks are the ones lending, and they are taking those loans, they're chopping up in a similar fashion as the CDO market. So and there's the different tranches. Remember, if you watched The Big Short, they kind of explain this. So if you need a primer on that, go watch that movie. But the different tranches means that they take losses as there are defaults. And so this is like the triple B, and you can see this is in a downtrend. So this is the J triple B. So this is the triple B CLO market. So if this is in a downtrend, it means that the risk is rising, that the triple B tranches, which is not the lowest tranche, but also not the highest tranche either, kind of somewhere in the middle, are starting to get riskier, meaning that there could be defaults piling up that start to hit some of these triple B tranches, and the market will start to price that in. And that's why you're not getting the weakness in, for example, HYG, because that's not where the risk is in this market. It's not, at least in the debt markets, it's not really in high yield debt. It's in that private credit. And so I continue to watch, the PSP is always a good proxy for these are the private equity ETF. So these are kind of a conglomerate of all those different publicly listed names. You have your Blackstone, or BlackRock, excuse me, and that's obviously peaked. This is kind of the strongest within the industry, but we know that they've gated transactions from BREIT, et cetera. So that's something to continue to watch out for. So yeah, there's BlackRock. Let's see what other sectors or areas I want to get into. Yeah, I mean, I've talked about how currency, that's kind of maybe number 3 on my list of risks. So AI number 1, private equity number 2, and as we go into next year, it's going to be on currency. Whether the dollar gets weak and you get assets leaving the United States because of that currency risk. Right now, everything seems okay. Here's the yen. So if the yen's falling, that means the dollar's rising against the yen. If you look at the FXE, this continues to kind of hang in there, a little pullback here, but I'll be watching for a breakout on this, as well as also the Swiss franc. So this one is also consolidating bullishly, kind of choppy sideways action this week. But if that gets a rally, you can start to see the broader dollar it be in decline, and then suddenly those, the Swiss National Bank, they bought a lot of U.S. assets, and so do they unwind their position if the dollar declines against the Swiss franc? So I think that remember, the Fed's easing, right, and the Fed looks to be pushing rates down even before Jerome Powell leaves, and who knows who the replacement will be. I think there's 2 Kevins, Kevin Warsh and Kevin Hassett, I think, are the 2 that are being discussed. And I think both would be pretty dovish on rates. And so does that push the dollar down? So, and create some sort of yen carry trade unwind like we saw last summer? And does that become wider, shall we say? So right now, not a big risk, not nearly as much, I think, as the PSP or the private equity space or AI unwind, but something kind of on the radar that I continue to watch. Gold continues to be strong. Right, you had a consolidation week. It's overbought. It still needs, I think, a longer consolidation period before that next big rally, but certainly could start at any time, especially if the dollar rolls over, right? So, I talked about this back in April when this was on the cover of Barron's about gold. It consolidated for 5 months, and then there was a lot of bullishness around in October, and this has just been kind of in a choppy but upwards pattern over the past few weeks. The gold miners as well, that's making new highs. So usually when gold miners are outperforming gold, that is a good sign. That means money is flowing into the space, and their investors are taking big risk with those names. So that uptrend in gold miners, outperformance of gold miners to gold, is certainly a good sign overall. Let's get into some of the ratios. Here's the private credit, or sorry, high yield short term to short term treasuries. So when this is in a downtrend, that means credit spreads are widening out. It's kind of sideways, kind of neutral right now. Not seeing a big breakdown, but I'll be watching this for a breakdown, but nothing to discuss on that front. IWM to the IWV, so a little pullback here. So large caps outperform small caps this week, but still you can see small caps are outperforming, especially since that August low. Foreign stocks as well. So foreign stocks remain kind of in this choppy pattern here. They try to break out on Monday, but kind of came back in on Tuesday and then chopped sideways. So overall, you're getting kind of similar returns over the past 6 months for domestic equities, US equities versus foreign equities, but obviously for the year, foreign equities still are outperforming. Let's look at the arc to the Qs. So we know that if this is rising, that means investors are taking more risk in the markets. If this is falling, and making less risk, because obviously ARK is way riskier than the Qs. And so you're getting a little rally here, but this week I had a bit of a pullback. So I'll be watching that for another rollover as we head into year end. Let's look at the growth to value trade. So we know that that has been faltering as of late. You know, that peaked back here around Halloween time. It's really been in a downtrend. This week kind of hung in there. We'll see if it gets to fall through to the upside. But I'll be watching that for a potential trend change, because we know the market is leaning on the growth side. So if growth outperforms, then markets kind of tend to hang in there. Lastly, let's go to, I love this one. This is one of my new favorites. So VIO, this is kind of like the arc to the Qs. If this is rising, it means investors are moving towards safer companies. So this is the VIO, the S&P 600 versus the Russell 2000. As I've said, the Russell 600, sorry, the S&P 600 has far more names that produce profits, and the Russell has a lot of names that actually have losses. And so if money is moving into safer companies, even though they're smaller but they make profits, then that is a signal that you're entering more of a risk-off period. So overall, this actually outperformed on the week. Let's see if there's anything else that I wanted to get to before we close for the day. I don't think so. Yeah. Overall, it was OpEx. It's really hard to glean a lot from OpEx week because of, once again, the this positioning from dealers. It's not as much of an investor's market, more of a speculator's market that's trying to unwind and shift their positioning as they enter the end of the week. So that was the week. That was, hopefully gave you some insights as we head into the holiday season. Obviously, there's not usually not a lot of trading volume in the last couple of weeks, especially I think this year, because Christmas is on a Thursday, New Year's Day is on a Thursday. You know, people are working maybe Monday, Tuesday next week, but obviously Wednesday is a half day. Friday, probably not a lot of people traveling, maybe not a lot of trading there, and kind of similar the following week as well. So I don't expect a lot of fireworks between now and year end, but we are shaping up for what I think will be a very interesting January, even if, you know, the next couple weeks might be a bit boring. So thank you all for tuning in and liking and subscribing to this channel. A reminder that the contents of this video are for educational purposes only and should not be construed as a recommendation to buy or sell security. The views are my own and do not and do not represent those of KP Financial or those associated. I hope everyone has a wonderful holiday season, and I'll be back on live maybe one more time before year end. Hopefully, I'll see you soon.